$70 billion flood and Fed frenzy, your money on the move. Markets are buzzing with contradictions. On one side, the August jobs report came in shockingly weak, with just 22,000 new jobs added compared to the 75,000 expected. On the other side, Wall Street is celebrating one of the biggest weeks of corporate bond issuance in history. Nearly $70 billion in new investment-grade debt sold in just 5 days. Layer on top of this the growing certainty that the Federal Reserve will cut interest rates in mid-September, and you've got a financial cocktail that could reshape the way money flows across the economy. This is the story of how weak jobs, cheap money, and a corporate borrowing blitz are colliding, and what it means for your money. The job shock. The jobs report was supposed to reassure markets that the U.S. economy was holding steady. Instead, it did the opposite. Only 22,000 jobs were created in August, far short of the forecasted 75,000. The unemployment rate ticked higher and wage growth slowed. For Wall Street, this was a signal. The labor market is cooling faster than expected. The immediate market reaction was dramatic. Treasury yields dropped sharply. Gold spiked toward $3,600 an ounce, and investors began pricing in a nearly 100% chance of a Fed rate cut in mid-September. This section will explore why jobs data is such a critical driver of Fed policy, how investors interpret weak payrolls, and why employment trends are often the canary in the coal mine for recessions. The $70 billion Bond Blitz. While Main Street was digesting grim job numbers, Wall Street was having a party in the bond market. In the first week of September alone, U.S. corporations issued nearly $70 billion of investment-grade bonds. This smashed expectations of $60 billion and marked one of the busiest weeks for corporate borrowing in history. Among the standout deals, Merck raised $6 billion to help fund a $10 billion acquisition, and Cigna tapped the market for $4 billion to refinance existing debt. The fact that companies are borrowing so aggressively tells us something important. They see today's borrowing costs as historically cheap, thanks to tight spreads and looming rate cuts. We'll break down how investment-grade bonds work, why issuance is seasonal, September is always busy, and why this year's frenzy stands out as a signal of corporate confidence or desperation. Why the Fed matters now. The Federal Reserve is at the center of this storm. With weak job data, inflation pressures easing, and global volatility simmering, the Fed has powerful incentives to cut rates soon. But every rate cut comes with consequences. Lower rates make borrowing cheaper, encouraging companies to issue more bonds and consumers to take on more credit. At the same time, savers see their returns shrink, pushing them to take more risk in stocks or real estate. This section will explore the Fed's dilemma, how to balance short-term market support with long-term financial stability. We'll also compare today's setup to past pivots, 2008, when the Fed unleashed unprecedented stimulus, 2020, when the Fed slashed rates to zero during the pandemic, and 2023, when dovish pivots fueled stock market rallies. Market effects of the bond flood. A $70 billion wave of bonds doesn't happen without consequences. For one, it reshapes the supply-demand dynamics in credit markets. Investors looking for safe yields are flooding into these corporate deals, allowing companies to borrow at historically low spreads. For another, it fuels a wave of M&A, buybacks, and refinancing that can pump stock prices higher. But there's a darker side. Cheap borrowing can encourage reckless financial engineering, where companies load up on debt to juice returns without building real economic value. This act will examine which sectors are leading the borrowing surge, how credit rating agencies view the flood, and whether this is setting the stage for stronger growth or another leverage-fueled bubble. Gold, silver, and safe havens. Whenever markets sense instability, safe havens rally. And that's exactly what's happening now. Gold prices are nearing $3,600 per ounce, while silver is also climbing. These moves signal investor anxiety about currency stability, Fed policy, and the sustainability of corporate debt binges. In this section, we'll explore why gold and silver continue to shine in uncertain times, how central banks are stocking up on bullion, and whether this rally is sustainable. We'll also contrast precious metals with other hedges like crypto and treasury bonds, and analyze what today's safe haven flows say about investor psychology. The bigger picture, fragility versus confidence. The juxtaposition is stark. Weak jobs data suggesting fragility, yet a record bond issuance spree suggesting confidence. Which story is true? The reality may be that both are true at the same time. The U.S. economy is slowing, but cheap money and financial engineering are keeping markets afloat. This paradox has defined many late-cycle moments in financial history, from the dot-com boom to the credit bubble of the 2000s. We'll explore how today's environment echoes those past periods, why investors should be cautious of late-cycle exuberance, and what signals to watch for to know when the tide is about to turn. What it means for you. The $70 billion bond flood and the Fed's dovish turn aren't just abstract finance. They affect your wallet directly. Rate cuts mean cheaper loans for mortgages and credit cards, but also lower returns on savings. Corporate borrowing may fuel stock rallies, but it could also increase systemic risk if companies overextend themselves. For individual investors, the key takeaway is to stay diversified, avoid chasing hype, and prepare for volatility. History shows that when markets flood with cheap debt, opportunities abound, but so do risks. If this breakdown helped you see the bigger picture behind today's headlines, smash the like button, subscribe for more urgent financial analysis, and drop your comments below. Do you think the Fed is making the right call by cutting rates? Are corporations being smart or reckless by borrowing so much? And where are you putting your money as September unfolds? Your perspective matters, and tomorrow's news could make this debate even more critical. This is Felix. See you next time.